Hello and welcome everyone. A very warm good afternoon. I hope all of you are doing good. I welcome you all to class number 2 of economy in this ongoing prelims crash course. Now, I really hope that all of you watched the first class that we had yesterday. Yesterday marked the beginning of this crash course for all of you who are planning to write the prelims examination on the 25th of May, that is the next month. As we discussed yesterday, our endeavor in these 14 classes of economics would be to cover each and every important aspect, important news related to economics that can be asked in the examination in some way or the other. We covered a bunch of topics yesterday. You can still see that video in the playlist. If you have not watched that video, that is the one from yesterday. Do yourself a favor and go and watch that. Today we'll continue from where we had left off. We will again be discussing some of the most important topics that have been in the news from economics point of view. Not just that, just like yesterday, we will also be discussing a lot of practice questions here for you. Because the entire objective is to get you prepared in the best possible manner to face the prelims examination in May. So with each and every question, or with each and every topic rather, we will have some practice questions and a related previous year question as well. Do me a couple of favors here. First, if you're new here, do hit the subscribe button so that you can get all the notifications and updates about the new classes that will be happening here on our YouTube channel. You can invite your friends also here. Secondly, please do make sure that you have a pen and a paper with you so that whatever question that we are discussing here, you can note down the answers and you can see at the end of the class how many did you get right, and you can also tell us in the comment section. Before we begin today's class, a quick reminder that if you are one of those who is planning to write the examination next year or maybe beyond that, we at Narayana IAS Academy are here to guide you to the best of our abilities. We offer 1 year and 2 year courses that will include comprehensive preparation not just for the prelims but the mains and the interview stages of the examination. The courses are aligned with the needs of the UPSC examination. That is why with ever-changing dynamics of the examination, the pattern of the course is designed to keep you updated along with this paper. It will have comprehensive coverage of current affairs. It will also have mentorship. It will also have your preparation plans one-on-one so that you can be best possibly prepared for this examination. It will have a lot of answer writing practice, prelims practice paper. Make sure that if you want any other information about these courses, you can check out the description of the video. You will find a link to our website. There will be all the information available regarding these courses. Please do check that out. On that note, let's begin from where we had left off yesterday and see what is the topic that we'll be starting with. The topic that we'll be starting our discussion with today is something called the windfall tax. Something that remains in the news time and time again, especially with respect to the oil sector, that is a fuel sector. In simple terms, a windfall tax is a situation where the government of India puts extra tax on an ad hoc basis for a short period of time on certain industries which are making a humongous profit without any effort of theirs. See, there are multiple ways in which a company can make an increased profit. You can have an increased profit because you're doing something good, because you innovated, because of the new technology that came out. But on the other hand, you may also have an increased profit not because of something that you did, but because of factors that are beyond your reach. For example, let's say you are a company that sells oil. You import oil from other countries into India and then you refine that and then you sell that to the petrol pumps. All of a sudden, if you see there is a decrease in the price of crude oil in the global market, you will automatically have humongous profits because your cost of importing crude oil will come down. So in certain situations like this, when the government sees that your profits are ballooning, that your profits are increasing, the government would want to take advantage of that. The government would want to make sure that if you are having a big share of the profit, let the government also have a pie of it. In that case, the government can put some ad hoc tax on that, which is called the windfall tax. Windfall tax comes from this word windfall. Windfall gain again means huge quantities of gain that you may have. And again, the important factor to note here is the profit should not be because of something that you did. If you innovated, if you are the company that is responsible for your profit, then the government doesn't put these kind of taxes. The windfall tax only comes into the picture when you did not have a role to play and you saw an increase in your profit because of certain conditions that are beyond your control. Now, usually these are the reasons when we have windfall taxes imposed by the government. For example, sudden increase in the prices means if you're selling something, all of a sudden, beyond your control or beyond the things that are in your control, something happened in the market and the prices of the commodities increased. For example, let's say that all your competitors had some problem and because of that they could not sell their commodities into the market and you are now the lone supplier of that. Automatically the prices will increase. If such a price increase happens because something wrong happened with your competitor and you are the only lone supplier remaining, that can result into windfall tax being imposed on you. Similarly, there's a situation of subsidies that have impacted your industry because of government subsidies that the government imposed or the government gave you. You were able to make many more money or much more taxes or much more profit rather. The government will put a kind of a tax there called the windfall tax. Then if there are economic gains due to again unexpected things, the condition is that you should not be responsible for your profit. It should be due to some factors that are beyond your reach. Under these circumstances, we see the government imposing windfall taxes. Now, the windfall taxes historically are not something that we see in India because see, whenever you talk about windfall taxes, the one big criticism that usually comes in that this is a socialist measure. Socialism, as you know, is an economic system under which the government controls the market. The government interferes in the business. The government decides what would you produce, at what rate can you sell, what is the quantity that you will produce. That's a socialistic system. India for the longest period of time had a socialist system. Windfall tax is considered as a part of socialist legacy. Why? Because the government is interfering, not allowing the private sector to make an increased profit. In a free market economy, in a capitalist system, for example, the government should not interfere even if the company is making a huge profit. That's how business is done. Because when the government does not interfere, when there are losses, why should the government interfere in the other way around? However, don't make this assumption that India is the only country that does it. Even the so-called capitalist countries have this provision of windfall taxes. In fact, this is where it all began. Capitalist countries such as UK, such as US also have a history of imposing windfall taxes. Although they don't do it now, but historically they have imposed windfall taxes. Like in UK specifically, windfall taxes were imposed on privatized utilities in late 1990s. Similarly, in the US, there was a proposal made in 1970s and in the 2000s as well, when there was a sudden increase in oil prices. Now, oil price increase again is something that can happen even when the things are not in control. I'll give you a simple example. Let's assume two major oil producing countries all of a sudden go on a war. That would lead to a disruption in the global oil supply. That would automatically increase the oil prices. That can be a situation where the government imposes windfall tax. I'll give you a real example. If you go back in 1990, that was a time that we saw the first Gulf War. Gulf War, that was a war between Iraq and Kuwait, where Iraq led by Saddam Hussein attacked Kuwait. Iraq and Kuwait, both of these are major oil producers. So when Iraq attacked Kuwait, there was a disruption in the global oil supply and there was a sudden oil price shock, where the oil prices suddenly increased drastically and every country in the world had to now arrange more money to import that oil. So when this oil price increases, anyone who is selling the oil would make a better profit without any effort on their end. This is a case of when the countries or the governments can impose windfall taxes. When we have a situation where your profit increases without you having any part in it. So again, it's not an India specific thing. It has happened in other countries as well. But usually we see this in the oil sector, energy sector specifically. Now there are arguments on both sides whether something like this, that is a windfall tax, is good for the economy or is it not good for the economy. As I said earlier, it's mostly socialistic in nature. It is the principle of socialism that the government tries to maintain a balance between the rich and the poor. It is a socialist principle that the government interferes in the businesses for the welfare of a few people. This is where windfall tax faces a lot of criticism. That is, it does not allow the companies to make hay while the sun shines. It does not allow the companies to actually make a better profit when the situation is in their favor. Because there will always be times in the business where the business will not be up to the mark, where you may make some losses. So to compensate that, you should allow the businesses to make good when the situation is in their favor. But windfall taxes goes against that entire principle. First argument against, it's a disincentive for investment. A company, an organization that is investing money in your economy, that is investing money to ramp up their manufacturing, when they know that the government can interfere anytime, when they know that the government can actually come in and disrupt their taxes or take away their money, this is where you are actually creating a negative environment for any investor to come in. There are also issues of administrative complexity, means how do you impose such taxes? Because see, the more taxes that you impose or the more complicated that the system is, you are actually playing into the hands of the bureaucrats. You are actually decreasing the ease of doing business. There's also risk of tax evasion. When you have tax imposed above a certain limit, you are actually discouraging people from giving away taxes. This is proven economically that when you go beyond a certain amount of tax, or when you go beyond a certain threshold of tax rate, people will do everything within their capacity to evade taxes. So higher tax rates would also lead to tax evasion. These are the arguments against the idea of windfall tax. On the other hand, there are ideas in favor of windfall tax as well. For example, the biggest argument in favor is it helps the government in securing public funds and it reduces income inequality. See, income inequality is a big problem of countries around the entire world. If you remember yesterday, and if you were attentive in yesterday's class, we had discussed something called the Gini coefficient yesterday. Remember? Gini coefficient that measures economic inequality, income inequality in a nation. That means when a few people, a few individuals control most of the wealth, they earn most of the money. That is measured by Gini coefficient. And that's a problem every country suffers from. It's not just a few countries that suffer from this problem of income inequality. So this income inequality thing can be curtailed, can be solved if the government imposes such kind of taxes, provided that the government makes good use of the money that they are collecting. These are arguments against and in favor of what windfall taxes are. Now, Government of India, and why is it in the news? It was in the news in the last few months because the Government of India had scrapped windfall tax. Scrapped as in they took it back. So why were they taking it back? First, there was a decline in the global crude oil prices. That's a very interesting situation in the oil market right now around the world. Gone are the days that there was a very limited supply of oil and there was a lot of competition amongst the countries to buy oil. We have now reached a situation where oil supply is enough in the market and even excessive in certain cases as compared to the countries that want to buy it. You have a lot more countries that have discovered oil reserves. Look at the US, that used to be the largest importer of oil in the world. Now they have discovered humongous reserves of oil and they are one of the largest producers of oil now. They even export a lot of oil. Then there are new discoveries of oil every few years. For example, the one recent case that you might have heard about is Guyana. The Central American country Guyana, that is in the Caribbean islands, they also got a lot of oil reserves now. So because of increasing oil price or increasing supply of oil in the market globally, we have seen globally the crude oil prices have reduced, have come down. Because they have come down, the local producers of oil, that is the domestic producer, the Indian producers of oil, now do not make a lot of profit. Please understand this. India produces about 15% of its crude oil requirement within the country itself. About 85% we import, 15% we produce ourselves. So the producers of oil within India were happy when the global prices were increasing because they could now sell their oil at a higher price. So government was imposing windfall taxes on them. Now that the global oil prices have reduced because there is a consistent oil supply, now we have a situation where the government has scrapped the windfall tax. Global market also has seen a lot of issues in the supply chain because of the Ukraine-Russia war, because of the Israel conflict, leading to a lot of reduction in the profits of the companies. That is why the government has basically scrapped windfall taxes for now. But the government did gain considerably from windfall taxes for a long period of time. Now, I'll just take a short detour here and discuss one more very important news related to oil, because we are discussing that, because these kind of questions are very commonly asked in the prelims exam as well. We were just discussing about the oil market because that is a market that is specifically usually affected by windfall tax. As I told you earlier, the global oil supply market right now is in a situation where we have enough supply, even more in certain cases as compared to what the demand is. We are seeing increasingly new oil deposits being found. And one very interesting example is Guyana. Guyana was in the news first because again a lot of oil deposits were found in Guyana. It's a very small country. And leading to that, you also saw the visit of our Prime Minister in November last year to Guyana. Now, Guyana is a very interesting country in the sense it's a part of the Caribbean island in Central America. It is a country that has a lot of Indian origin population. Now, these kind of questions are asked in the prelims. For example, the area or the region where the oil deposits of Guyana were found was in the controversy. Why? I'll introduce one more very interesting nation for you here. That is Venezuela. I know all of you have heard the name Venezuela. Venezuela is a very interesting country, especially when it comes to oil. The largest proven oil reserves in the world, again the largest proven oil reserves in the world are in Venezuela. No country has more proven oil reserves in them. And yet, Venezuela is suffering from a lot of economic issues. Unlike countries such as UAE, Qatar, Saudi Arabia, that have built their entire empire based on oil and gas, Venezuela, despite having the largest proven oil reserves in the world, is suffering from humongous inflation. They have economic instability. All of that has led to Venezuela suffering from a lot of issues. Inflation, in fact, in Venezuela was thousands of percent just a few years back. Now, why am I telling you this? Because a few months back, when there was this oil discovered in Guyana specifically, Venezuela is a country that shares their border with Guyana. Venezuela started to say that no, this is our territory, this is a territory that belongs to us. We will control this. Now think from Venezuela's point of view, they're not even able to extract oil from their own region, and now they want the region from Guyana as well. Now this is where two regions are important for you to remember from the prelims exam point of view. First region is this, Essequibo region. This Essequibo region in Guyana is a region that shares its border with Venezuela. Venezuela for a long time has been claiming that they should be the one who should be controlling this region. This is where the oil deposits were found earlier. Now there is one more part of oil that has been found. That was in 2015. That's called Stabroek oil block. Again, the Stabroek oil block here, as you can see, it's in Guyana, but Venezuela again says that no, it belongs to us. Now, these kind of questions, facts, or places in news are asked by the UPSC very commonly in the prelims exam. For example, they can just ask, Stabroek is a place that was recently in the news, it belongs to which country, or it is in which country. Similarly, they can say, Essequibo region that was recently in the news is in which country. So all of these are Guyana. That's why these kind of things are important, not just for the mains but the prelims exam point of view, because the places in news part remains extremely important. Now, again, I'm telling you this in the windfall tax part because this is relevant to understand how the oil market in the world is actually changing. And this is why you have to understand how or why our Prime Minister's visit in Guyana was so important. Now, I have a few practice questions for you. Just like we did yesterday, I would want you to pause on this screen, read the question carefully, think about what the answer is, write the answer in the sheet of paper, and then play again and we'll discuss this. You can read this question carefully. If you want, you can take a screenshot as well. And you can pause for a bit. Alright, so I hope that you have all gotten your answer written down in the piece of paper. Let's see whether you are right or wrong. So the question is, consider the following statements regarding windfall tax in India. First statement, windfall tax is levied under provisions of the Income Tax Act 1961 as an additional surcharge on profits exceeding a certain threshold during a high commodity price cycles. No, it is not levied under the Income Tax Act. It is levied under the Excise Act. So we have an Excise Act in India. It is under that this is actually levied, not under the Income Tax Act. Second, in India, windfall taxes on crude oil and petroleum products are revised periodically and are not fixed annually in the union budget. That is correct. See, in the union budget, you cannot make provisions for it because these are ad hoc taxes. These are based on situations. When the government thinks that there is a lot of profit being made by the company without any of their effort, then they will put it. The budget would only have those things that are planned in advance. So second is correct. Third, the imposition of windfall tax is WTO compliant as it does not involve export subsidies or discriminatory trade practices. What it means to say that WTO does not speak against windfall tax. They allow it, which is correct. See, the problem that WTO may have, or the only problem that they have, is when your policies distort international trade. So when your policies lead to products becoming cheaper or expensive, and when they go in the international market, that would lead to disruption of international trade. This is where the WTO is not happy. So as long as you're doing something internally within the country, it is absolutely fine. So 2 and 3 are correct. 2 of these given statements. First statement is wrong. The answer thus would be B. Only 2 are correct. First statement is wrong. I hope that you got this one right as well. If you want, you can take a screenshot as well. As I told you, the windfall tax is imposed under the Central Excise Act and not the Income Tax Act. Okay. I have one more question for you for your practice here. Read this carefully. Again, if you want, I'll just give you space. Read it carefully or take a screenshot and then pause on this screen. Think about the answer, write the answer in the sheet of paper. And once you have decided your answer, then you can play again. Alright. With reference to windfall taxes, consider the following effects in the Indian context. Number 1, they can help the government contain fiscal deficit without creating inflationary pressures. See, it's a loaded statement. See, what they are trying to say is, when the government is in a deficit, when the government requires more money, there are different ways in which the government can increase money supply. The easiest, but which is not very sensible, but the easiest way is to print more money. Ultimately, the printing of the money is in the hand of the government only. But printing of free money, printing of excessive money leads to inflation, leads to prices of commodities increasing. So that is not really an ideal situation. So what they are saying is, if the government wants more money for which they impose windfall taxes, that is a good way to arrange money without inflation happening, which is correct. Second, they may disincentivize investment in upstream oil and gas exploration in the long run. We discussed this. This was an argument against windfall taxes, that you are discouraging the investors from coming in and putting in their money. Because when the companies or the investors know that the government will not allow you to make a large profit, when the government thinks your profit is going way beyond, they will have a share of it. It will disincentivize investors from coming in. Third, they violate the principle of tax certainty and predictability, which can negatively impact investor confidence. Again, the same thing. See, as an investor who comes in and brings in money, let's take an example. Let's say Apple brings its manufacturing to India, or Tesla brings the manufacturing to India. They want to manufacture their cars in India. there is one component of how much taxes do they have to pay. The companies obviously want to pay lesser taxes, that is fine. But the bigger part or the more important part that the companies want is predictability. Predictability as in, if you told the company that the government in India imposes a 10% tax or 20% tax or whatever, it should be predictable. That is, it should be then the same for long period of time. You cannot have a situation where for the first year you impose 10% tax, next year 15, then 25, then 30. You can't keep changing that because that runs against the business. This is where predictability comes in. So this is again the argument that it's unpredictable. It discourages the investors from bringing in their capital. So the answer in this case would be all these three are correct. D. 1, 2 and 3 here are absolutely correct. Now, on top of that, I wanted to give you one extra bit of information here. Since we are talking about taxes and predictability of taxes, is something again very important that you should know. That is something called the canons of taxation. Canons of taxation. Now, what is canon of taxation? The word canon basically means principles or rules. So, in economics, you might have read about this, that there are 4 canons of taxation given by Adam Smith. Who is Adam Smith? Why is he famous? I really hope that you have read this in economics. Adam Smith, very, very famous author in the 18th century. He wrote this book called Wealth of Nations. Wealth of Nations, that became the ground for the countries imposing capitalism or adopting capitalism. Now, in the book Wealth of Nations, Adam Smith talks about 4 canons of taxation. Means he talks about the 4 principles, the 4 rules of taxation that everyone should adopt. This is a very, very important piece of information that you should remember. What are the 4 canons that he talks about? He says, first, canon of equity means fairness. So tax, whatever the country applies, the tax should be fair and just. It should be in proportion to their income as much as possible. That is called what? There are 2 types of taxes, if you remember. There is progressive taxation, there is regressive taxation. So this is progressive taxation. In simple terms, the more you earn, the more you pay. Mr. Ambani would obviously or should obviously pay higher taxes than other people because he's earning more. So that is the principle of equity or fairness. So that is the first principle in the 4 canons of taxation. Second canon, canon of certainty. This is what we were discussing just a few minutes ago. This particular canon is violated by windfall tax. The reason why companies don't like windfall tax is because it violates this particular principle. Principle or the canon of certainty. Companies want long-term certainty in how much are they going to pay to the government. That is how they can make plans for the long term. You can't randomly tell a company or an organization that today it's 30% tax, then 40, then 50, then 10, then 5. That is not how long-term taxation should work. Third principle is canon of convenience. It should be convenient to pay taxes. For example, the TDS. If you're a salaried employee, the salary that you get, the company first deducts the taxes and the taxes are then deposited to the government and the remaining money you will get. So that basically is convenient for you. You don't have to go to the government and ask for the government to pay taxes. It should be convenient. Then fourth, canon of economy means collecting of taxes should not cost you a lot of money. Because if it costs a lot of money to the government to collect taxes, then it defeats the entire purpose. Ideally, taxation system should have these 4 canons. Do remember that. It is important. It can be asked in the prelims examination as well. Before I move on to the next topic, I also have a previous year question for you related to what we are discussing. Let's see if we can answer this one here. This was a question asked in 2011 about tax. The question is, which of the following is not a feature of VAT or value added tax? Value added tax, much of it has been subsumed ever since the GST has come in. But you still have VAT. For example, if you go to a restaurant, you will notice when the bill comes in, the drinks that you have, the beverages that you take, they are not under GST. On that, VAT is separately put. That is value added tax. Now, in that context, see if you can answer this question. Again, pause on the screen, read the question very carefully, think about what your answer is, and after that, you can play. I hope you do that. Okay. First, it is a multi-point destination-based system of taxation. That is correct. It is levied on value added at each stage of transaction. That is why it's called value-added tax. It's a tax on final consumption of goods and services. Yes. It is a subject. It's basically a subject of central government, and state governments are facilitator. No, 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 no. VAT is basically imposed by the state government. It's the state government that controls VAT. They decide the VAT, they impose the VAT, they collect it. So VAT specifically is a brainchild, or it is a commodity that is in control of the state government, not the central government. You have to tell which of these is not a feature. D is not a feature. That will be your answer. I hope you got this one right as well. On that note, let's come to the next topic that we have. The next topic that we have here is something that has remained a lot in the news, not just last year but earlier as well. Something that the government uses in order to make its performance look better. That is the idea of off-budget borrowing. Now, what is off-budget borrowing? Let me explain this to you in very simple terms so that it's easier for you to understand. The government of India has to give a record of all its transactions in the parliament and then in the budget. So in the budget speech that is given by the finance minister, the government of India has to give a record of how much money are they expecting to spend, how much money are they expecting to earn, what is the difference between them, so on and so forth. Every government tries to reduce the gap between its spending and its earning. India is always a fiscal deficit or budget deficit country, means we always spend more, or we have to spend more than what we earn. Now, how we make up for that difference, how we reduce that difference, has always been a matter of concern for the government. In the past few years, the governments have identified a way out, or a kind of a method through which they can actually make their data look better. That is called as off-budget borrowing. Now, understand this idea. I'll give you an example with the help of a government organization so that you can understand. Let's take an example of FCI, Food Corporation of India. Now, FCI or Food Corporation of India is a very important body. They are the ones who procure grains from the farmers on the MSP. They buy wheat, they buy rice, they buy other commodities as well. And then they are the ones who distribute to the public under the PDS, that is a public distribution system. Now, when Food Corporation of India buys some stuff from the farmers at a higher price, for example, let's say they are buying rice. Let's take an example. They are buying rice at 30 rupees per kg from the farmer. Okay. The same rice has to be sold by them under National Food Security Act at 3 rupees per kg. So they are making a loss of what? 27 rupees per kg. That's a loss because they are buying something at 30 rupees, selling at 3 rupees. So obviously they are making a loss. Now how do they cover that loss? The government has to give them the money, as simple as that. So earlier what used to happen was government used to write that in the budget, that in this year we will be giving, let's say, 1 lakh crore rupees to Food Corporation of India. We will be giving this one money to FCI. So it was a part of the budget. Now the government thought, while writing this in the budget, our list of expenditure is increasing. So what is happening here is government is saying, okay, we will not write this in the budget. Rather, we will ask the Food Corporation of India that if you want this money, you go and take a loan from the market. You go and take a loan from the market. Government says, I will pay back the loan. You don't worry about that. The loan I will pay back, but you just go and take a loan. So rather than the government directly paying to the Food Corporation of India and mentioning it in the budget, the government and the FCI, you arrange money from somewhere else. Why? Just so that the government doesn't have to write that in the budget. That is called off-budget borrowing. When the government borrows money, because this is indirectly a borrowing by the government only, because it is the government's expense, not the Food Corporation of India's expense. They are the ones running this scheme. So when the government borrows money from the market, through its companies, through its organizations, indirectly, so that officially they don't have to include that in the budget, that is called as off-budget borrowing. This is what is happening here. It's similar to saying, let's say you need 100 rupees something, you want to get a loan of 100 rupees, you are too shy, you don't want to go to your parents and ask for 100 rupees. So you send your younger brother, you send your younger sister that go to the parents and ask for 100 rupees and then give it to you. So that you don't have to face them, you are not the one, you are not the party that is actually getting money from them or taking money from them, but it is you who is actually gaining out of it. That's similar to what off budget borrowing is. So government does it so that they don't have to show it in the budget, and they can tell the public that, see, we are reducing our deficit. See, we are reducing our borrowing. See, we are not taking so much money from the market now. See how good we are. So that's an indirect way of, I don't want to be harsh, but it's an indirect way of fudging the figures, of not presenting the correct figures to the public and not telling them the real story transparently. Now, why is it in the news? It's in the news because this ongoing practice, now it's not a new practice, it has been going on for some time now. It's in the news because this ongoing practice has been flagged by the 15th Finance Commission and the CAG. Both of them have said that this is something that goes against the ideals of transparency and sustainability. Against transparency because you're not telling the public and the parliament clearly how much money are you borrowing, how much money are you taking from outside. That should be clear to the public. Second, it's not sustainable because when the next government would come in, whenever they come in, and they should have a clear picture of how much money do we owe to the people, how much money do people owe us, all these things which are not in the budget, you are not actually showing them. So it is not a very sustainable way of running the government. You can keep on taking more money, you can keep on borrowing more money, and it will never be shown in the budget. People might think, oh, the government is running successfully, the government is running without any losses of borrowing, but the reality will be different, so it's not even sustainable. This is why it is in the news that Finance Commission and CAG say that this practice should be curbed. This is what off-budget borrowing is. As I told you in very simple terms, when the government raises funds through some other agencies, through some government organizations, through some government agencies, without having to reflect the same in their own records. This helps the government cleanse their record, or this helps the government show a better picture. Now, why is it that the government has to show a better picture? There has to be a reason for it, right? Why does the government want the people to think that, no, we are doing a good job? Why is it that the government wants to show a better picture than what exists? Because we have a law in India called FRBM. That is Fiscal Responsibility and Management Act. Now, if you actually look at the Fiscal Responsibility Act, this is where the government of India has been given a target to reduce their fiscal deficit. When the act came in initially, the FRBM Act, it said that the government should reduce the fiscal deficit to 3% of the GDP. 3% of GDP. But then government realized that it's not really a goal that can be achieved. When then the COVID-19 pandemic happened, it gave even a bigger reason for the government to say that it can't be achieved. So the government has revised that target, and the government says that, okay, 3% is a bit too much, we'll do that later. Right now, we are aiming for 4.5%. So we are aiming that our fiscal deficit should be within 4.5% of the GDP. So to bring that fiscal deficit under this limit of 4.5%, eventually 3% later on, the government does these kind of things. That is, they don't show in their own budget that they are borrowing this much money. And the borrowing is being done through the government companies and government agencies. This is another example, the Food Corporation of India example that I gave you, that they are the ones who get loan or they are the ones who take loan, and the government doesn't have to show it. Again, it will be repaid by the government only. It's not that the government will not repay it. Government will only repay it, but it's just not shown in the budget. Now, there are various ways in which off-budget borrowings actually take place, or the government raises money in this manner. First, issuing of bonds. Government agencies issue bonds. Bonds is a very simple way of raising money. If you don't understand bonds or securities, the simple idea is, let's say I want certain amount of money, and I will go in the public and ask them, do you want to give me the money? Let's say I want 5 crore rupees or 5 lakh rupees. If you're ready to give me the money, let's say I take cash from you and I will give you a piece of paper. In that paper, I will write that I have taken 5 lakh rupees from you. I will return after 2 years with 10% rate of interest. That's called a bond. When you are raising money against that guarantee. Government agencies also utilize their saving, whatever saving that they have had. They may also borrow. They may also ask the money from the banks. Again, the government is not doing this. Government is asking their entities, asking their organizations to do this on their behalf, so that it doesn't have to be shown in the government's borrowing. That is the entire idea of off-budget borrowing here, which works in the government's favor. There are other examples of how this money is raised. Government usually, because the government has a huge food subsidy bill, for example, and let me in fact ask you a quick question here. Think about which is the biggest subsidy item for the government. Right now, if you think about what is the sector, what is the field in which the government gives the biggest subsidy, think about it. Many people think that it is fertilizer. In fact, the reality is fertilizer now is at the second place. The biggest subsidy bill for the government of India is the food subsidy. As you know, we have the National Food Security Act, under which rice is given at 3 rupees per kg, wheat at 2 rupees per kg, millets and other coarse grains at 1 rupees per kg. That money that the government spends in bringing down the cost of food grain, that is a food subsidy, that is by far the biggest subsidy bill for the government of India. On second place, we have the fertilizer. These kind of facts are asked very regularly in the prelims examination, so you must know. Again, as I told you yesterday, even if you don't know the exact number, just know which is the biggest one, which is the second, which is the third, etc. Anyway, so this is how off-budget borrowings are raised. The Food Corporation of India is asked to take a loan from, and they might take a loan from government agencies also, they might take a loan from other enterprises as well, which is eventually to be paid back by the government only, but does that for now, it doesn't show in the budget of the government. This is the act that I was talking about, FRBM, the Fiscal Responsibility and Budget Management Act. Initially, it was introduced in 2003, and the idea was the fiscal deficit should come down to 3% of the GDP. Because the government was lagging behind, and then again, COVID-19 pandemic hit, we had in 2016, there was a committee formed by the government called N.K. Singh Committee. N.K. Singh is the same person who was the head of this Finance Commission, whose reports are valid right now. N.K. Singh Committee had suggested to make certain changes in the FRBM Act. They are the ones who said that achieving 3% of GDP as a fiscal deficit target would be almost impossible. Let's increase it to 4.5%. Apart from that, the FRBM Act also says that the government should bring its public debt under control. The debt that they have taken from the public should be under control. The target that the FRBM Act puts for the government is your debt to GDP ratio should be 60%. So again, the debt that you have taken to the GDP ratio should be 60% and not beyond that. Out of this 60%, 40% from the side of the central government, that is their debt, and 20% debt can be from the state government side. That is the aim or the goal that FRBM Act has put. Now please understand here, if the government does not fulfill this target, if the FRBM Act gives a target, the government does not fulfill this, is there a penalty to it? Not really. The government will not be removed, or there will no action will be taken against the government just because you did not fulfill the obligation of the FRBM Act. But these kind of things just give a kind of, let's say, ammunition in the hands of the opposition to hold the government accountable, to tell the public that, see, the government is not running properly, the government is not running carefully, but there is no punitive action that can be taken against the government just because they are not able to abide by such kind of laws. Ultimately, it's in the hand of the government only. The government only introduced the FRBM Act. They only made the changes. So tomorrow, if they want, they can make even more changes. There is no stopping the government from doing that. So there is no specific penalty. But again, it's not a good look for the government if they are not able to achieve the target that they had set for themselves. And that is why the government does these kind of things, which is the off-budget borrowing. On that note, let's see if you can answer a few questions here if you understood the topic. Again, we'll do the same stuff. Pause on this screen, think about what the answer should be, write it in the piece of paper, and once you have read that question, answered the question, and then you can play again to see if you were right or wrong. Okay, let's see. With reference to off-budget borrowings in India, consider the following statements. Number one, All budget borrowings are not reflected in the Union government's fiscal deficit as per the FRBM Act of 2003. Exactly what we have been discussing. This is the entire agenda of the government of using the concept of off budget borrowing so that they don't have to show it under the FRBM Act and they can have a clean slate and say that, see, we are not spending so much money. Expenditure financed through off budget borrowing is subject to parliamentary approval. No. It is not subject to parliamentary approval, which is why it is the easiest option available for the government to improve their numbers, and they do that very, very regularly because the parliament does not have any role to play as such. Third, they are typically undertaken by issuing bonds or raising loans through public sector enterprises with the liability resting on the union government's balance sheet. No. If that was the case, then the entire point of off-budget borrowing would have been defeated. The entire point is that it will not be highlighted on the union government's balance sheet. Means it will not be shown in their accounts as a liability. That is why they take it. So third is again wrong. The answer is only one of these is correct. First one, A would be the answer here. I hope you also mark this as A. If not, please do learn from this. If you want, you can take a screenshot here as well. What exactly are the explanations of each of these given statements? Let's have one more question. Again, do the same. Pause on the screen, read the question carefully, mark your answer, write down your answer and see if you are able to get that right. Once you have done that, you can play again and see if you got that. Consider the following statements of examples of expenditure historically financed through off-budget borrowings. So you have to tell which of these are actually examples of off-budget borrowing. The government has done that historically. Which of this is off-budget borrowing? First, food subsidy areas financed through the loans. Here we are. So first is food subsidy areas financed through loans raised by Food Corporation of India from the National Small Savings Fund. Yes, this is what off-budget borrowing looks like. As we had discussed, asking the Food Corporation of India to take the loan rather than the government coming in between. They might take a loan from the government agency itself. So in this case, they have taken a loan from National Small Saving Fund. Second, capital support to Indian Railways funded through Indian Railway Finance Corporation bonds outside the union budget. Again, yes, it's an example of off-budget borrowing where the bonds are issued not by the government, because if it is issued by the government, then it becomes the government's loan. The bonds are issued by the government agency. That is the IRFC bonds. So yes, this is also off-budget borrowing. See, something that cannot be traced back to the government directly. Something that the government is not doing, they are not involving themselves, that will be off-budget borrowing. Third, grants to Uday scheme for Discom. Discom is distribution company, it is electricity distribution companies. For Discom revival, finance to state borrowing. See, again, the problem is when you are saying it's a state borrowing, means it is budget. It is a part of the budget. When you don't involve the government or the state directly, then it is off budget borrowing. But when you have involved the government here, when you involve the state and they are the ones who are borrowing, then it's not off budget borrowing anymore. So off budget borrowing examples are 1 and 2. The answer here would be A. I really hope that most of you got this right, that you marked A as your answer. If not, you can evaluate and see where you went wrong. You can take a screenshot here if you wish to. Now I have a related to it previous year question, not exactly, but related to it, there is a previous year question. Let's see if you can get that one also right. Again, we'll do the same thing. I want you to pause on this screen, think about what the answer is, read the question carefully, write it in your piece of paper. When you are done with that, you can play. Alright, so the question is, which of the following is likely to be the most inflationary in its effect? Now, I really hope that you have learned your basic economics about inflation. So, inflation simply means rise in the general commodities, the price of general commodities are increasing, not just one or two, but when generally commodities increase their price, that is called as inflation. There are various ways, there are various reasons why inflation occurs. For example, when there is excess money supply in the market, that is when inflation occurs. Take a very simple example here to understand. Let's say that there are 1000 kgs of onion that is grown in the country. Let's just make this assumption that we only have 1000 kg of onion that is grown in the country, and this is sold in the market. Now let's say that this is sold in the market at 100 rupees per kg. So the people who can afford to buy it at 100 rupees per kg, they do buy. The people who can't afford to buy, they can't buy. That is an equilibrium that has been set. Now let's assume all of a sudden the government keeps up its promise, the promise that they had made, that we will deposit 15 lakh in everyone's bank account. Let's say the government keeps up the promise and they all of a sudden deposit 15 lakh rupees in every Indian's bank account. Now what will happen? The supply of onion is still the same. There is only 1000 kg available in the country. But the change now is that everyone has at least 15 lakh in their bank account. So the situation will be everyone will be able to afford this now. Not just afford this, because the supply is limited, there will rather be a competition to buy this now. Someone will say, oh, I will give you 500 rupees, give me 1 kg onion. Other person will say, I'll give you 1000 rupees, give me the onion. Someone else will say, I'll give you 5000 rupees, give me the onion. Why? Because everyone can afford to spend that money now. They have that money in the pocket and the supply is limited. So in simple terms, inflation occurs when you increase the supply of money in the market without having a parallel increase in the production capabilities. When the production capabilities are the same, that is the same amount of onion is being produced, but somehow you have increased the money supply, that brings in the inflationary effect. That's the simple logic of inflation. The reverse also is true. For example, all of a sudden you have an increased demand, but the commodities remain the same, and at the example that we discussed here, that is what brings to a rise or brings to a situation where the price of the commodities will start to increase. The supply can also be reduced. On the contrary, imagine that everyone has the same amount of money right now, but the supply of onion has been cut short. You know, every year you have a time period where onion prices shoot up. Every year we have a situation where tomato prices shoot up. Why? Because that is the time that the supply of onion or tomato is cut short. So when you have shortage of supply, same amount of people who are acting to buy, they will again jack up the prices because everyone will be trying to buy and everyone will be able to or willing to pay more. That's what inflation is. So with that background knowledge, let's try and answer this now. Which of the following is most likely to have inflationary effect? That is, inflation will be because of which of these? Repayment of public debt, that is the government giving the money back to the public. See, when the government gives people back their own money, it's not new money, then it will not lead to inflation. Borrowing from public to finance a budget deficit, not exactly you're borrowing from the public, so you're taking the public's money away, you're reducing the money supply, it will not lead to inflation. Borrowing from the bank to finance a budget deficit, that again, government will spend money in the market, but the borrowing from the bank will mean money supply is reducing from the market. Banks will not be able to give loan to the public because they are giving loan to the government itself. Fourth, creation of new money to finance budget deficit, yes, that will lead to inflation. When we mean creation of new money, means printing of new money. That will lead to inflation. So the answer here is D. This is the one that is most likely to have an inflationary effect in the market. D would be the answer here. Okay, I hope you got this one right as well. Now we have the next topic that is called long-term capital gain tax. This is one of those things that remains quite a lot in the news, especially nearby the budget speech. When the budget speech is announced by the finance minister, there are a few talking points everyone talks about in the news is income tax and etc. But one other thing that everyone talks about is long-term capital gain tax. Now, please, let's understand this in very basic terms, what exactly we mean by this. What is long-term capital gain tax? When you have a certain commodity, let's say you buy a house, okay? Let's imagine that you buy a house or you buy stocks or whatever. Let's say you bought a house for 1 crore rupees, okay? Now, after that, you saw that the price of property is increasing, you did not sell the house, you waited for a few years. Eventually, after let's say 7 years or 8 years, the price of this house becomes 2.5 crore. Now you sell this. Now when you are selling this, you are making a profit. The profit that you made is 1.5 crore. On this profit also the government will take a tax. This is called long-term capital gain tax. If you sell a certain asset after certain number of years, the profit that you have in that, you will be taxed on that. That is called long-term capital gain. On the other hand, if you sell your commodity below a certain number of years, then you have to pay something called short-term capital gain tax. So it's not that you don't have to pay a tax if you are selling it quickly. If you are selling it quickly or in a faster manner, then again there's a tax imposed, but that will be called short-term capital gain. This is long-term capital gain. That is the difference between the two. Now, usually the governments try to make sure that people are discouraged from selling and buying very quickly. Because when you buy right now, then you sell again, then you buy again, sell again, it kinds of create a volatility into the market. So mostly you will always see the government tries to push people towards holding asset for slightly long term. That is why always you will see that the rate of long term capital gain tax will be smaller than short term capital gain. The government will charge your tax in both the cases. The difference is in long-term capital gain, the tax might be slightly lower as compared to short-term capital gain, because the government wants you to hold the asset longer so that it does not create a lot of volatility into the market. Now, usually, generally in India, the time period that distinguishes short-term and long-term is 3 years. So if you sell something after keeping it for 3 years, that will come in the long-term capital gain. If you sell something after keeping it for less than 3 years, that is short-term capital gain. That is a general rule, but there are a few exceptions. Like property is an exception, stocks is also, shares also are an exception. So there are usual exceptions that we will discuss about, but generally it is 3 years that is taken for certain commodities, most of the commodities, to categorize them into long-term or short-term. Now, it was in the news, as I said, because every year in the budget speech, the finance minister announces what will be the tax, the short-term capital gain, long-term capital gain tax for this coming year. That's why it remains in the news every single time. It changes time and time again. It mainly affects the people who are dealing in shares, who are dealing in the stock market, affects them much more than others. But it usually is an important indicator for the economy. It indicates that the government is trying to raise more money, and when the government is spending a lot on other activities, subsidies or capital expenditure, how do they get this money? This is where it helps them. So long-term capital gain, as I said, usually 3 years for most of the stuff, but there are certain exceptions. One big exception is the shares and mutual fund. Now, if you do invest in shares and mutual fund, you would have seen this, that when you are selling it, if you sell your mutual funds or your shares before 1 year, so if you have bought it today and you're selling it within 1 year, then you will be taxed under short-term capital gain. That's a higher tax rate. So the mutual funds will give you kind of a warning message that if you sell it right now, there will be higher tax imposed at the short-term capital gain. So hold it a bit longer, then then you will be imposed long-term capital gain that's lower at least. Long-term capital gain on non-financial assets usually is 12.5% now as per this budget speech. So it was 10 earlier. The budget speech that came in, the budget that has become now valid from 1st of April now, that is 12.5% long-term capital gain. Short-term capital gain, on the other hand, is imposed on assets that is sold in the short term. That will attract a tax of 20% instead of 15%. So that's pretty high. In case you are selling an asset before a certain time period, it will impose a tax of this much. Now again, there are a few things to understand. First, it is only imposed on the profit part, not on the entire value. The example that we took, if you bought a house for 1 crore, you are selling it for 2.5 crore, the profit in between, the 1.5 crores of profit that you made, it is on that the tax will be imposed. It's not imposed on the entire 2.5 crore. First. Second, there's also something called offsetting of losses. Now, what is offsetting of losses? Let me give you an example here. So, offset of losses means, let's assume that you have two properties. Okay. One property, as we discussed, you bought it for 1 crore, sold it for 2.5. So, you made a profit of 1.5 crore. But there was another property that you had bought for 1 crore, but because of certain problems, you could only sell it for 50 lakh. So, in this case, you had a loss of 0.5 crore. So, the tax that you will have to pay will not be on this profit now. You can offset this loss, means you can add these up. Net, you are in 1 crore profit net. So, on this net value, you will have to pay the tax. It's not that you have to pay the tax irrespective of if you made a loss or not. If you made a loss, then you can actually make sure that this loss can be offset. And it doesn't have to be this year only. This offset, in that, let's say I made a loss this year, I can use this to offset my profit in the next 8 years. So in the next 8 years, every time I'm making a profit, I can deduce any time the loss that I made so that it is offsetted. So there is an offset option that is available. Also, it is not imposed on all the profit. There is certain amount of money that the government lets go. So the government says that the increase in limit on certain listed financial assets means stock and shares, etc. will only be after 1.25 lakh of profit per year. So if you have sold a mutual fund or a stock, etc., up till this much profit if you made, there will not be any tax. There will be tax if the profit increases, or if the profit goes beyond this. That is how the long-term capital gain tax or short-term capital gain tax has been imposed. These are different types of assets on which the tax is imposed. So there are capital assets like vehicles, land building, jewelry, etc. that has that monetary value. And then there are inherited properties. What about inherited properties? So if, let's say, someone in your family passed away and you inherited that property, you are now the owner of that property. Do you have to pay a tax on that? Just because you inherited something, you don't have to pay a tax. Now, if you remember, a few months back, there was this big debate as well. There was, I won't take a name, but there was this big leader of the Congress that had suggested that just like the US has inheritance tax, India should also have an inheritance tax. Inheritance tax means, let's say if someone passes away, very rich person, and they have given a lot of their money to the next generation, a part of that should be taken by the government as inheritance tax. India does not have that. Many developed countries do have this. Anyway, so if a property is inherited, then there is no tax on that. But when you sell the inherited property, then there will be a tax. So when you sell the property that is inherited, then there will be a tax. But if you got something in the form of gift, in the form of inheritance or will, that is exempted. Then you would not have to pay any tax. That is exempted. There are certain other exemptions also in detail, and I'll just discuss about this as a part of these questions. So we have some interesting questions for you here once again. We'll do the same thing. I would request you to pause on the screen, read the entire question, mark what your answer is, write it down, play it again so that we can discuss this. Now this is slightly tricky. Rather, I would call it a difficult question, because they are not just asking about exemption, they are asking about specific sections. Now in UPSC, you might get certain high level questions, which is an example here. Consider the following types of assets and their treatment under long-term capital gain tax in India under FY 2024-25. You have to tell which of these are eligible for exemption under section 54F or section 54 upon reinvestment into residential property. Whew, difficult. Let me first try and explain what the question is. So what the government tells you is, the example that we took, that is the house that you bought for 1 crore, you sold it for 2.5 crore and you made a good profit of 1.5 crore. This is the example that we took, right? Now the government says the money that you have made here, this money, if you reinvest this into buying a residential property again. Means if you buy a residential house from this money, then we will not put taxes on you. Because the government wants you to buy a house, the government doesn't want you to not be able to buy a house because of them. So government says that if the profit that you have made, that profit is reinvested into residential properties, then you will be given exemption. However, that is only for certain examples. So this is what the question is asking. That under these sections, which of these, if you make a profit in and you invest that money into residential property, then it will be exempted. It's a difficult one. Let's see. Residential property, yes. So if you sell a house, then you again invest the profit in the house only, then there will be no tax on the profit that you made. If you made some other use for that money, you went on a world tour, you went on a luxury tour, you got something else, a luxury car, etc., then there will be taxes imposed. But if the same money used for residential property buying, then it is fine, no taxes. Sovereign gold bond, no. So now please look at this. Sovereign gold bond, the government scheme under which you can buy the bonds rather than buying money, rather than buying gold rather. The sovereign gold bonds are anyways tax exempt. If you sell them after 8 years, they are anyways tax exempt. They don't come under long-term capital gain thing. So they are exempted anyways from taxes, but they are not under this section. So it's not a part of this answer, because the question is which of these are exempted under these two sections. So sovereign gold bonds are not under these two sections. They are exempted anyways separately. Unlisted shares, yes, they also are a part under these sections. Unlisted shares basically means, there are many companies that offer something called ESOP. You might have heard of the word ESOP. Some companies offer shareholding or ESOP to their employees. Those companies are not listed in the stock market, so common public can't buy those shares. But because you are an employee of the company, as a part of salary or as a part of incentive, you are given ESOP into the company, then those shares, if you sell them, unlisted shares, those shares again, if they are invested, the money is invested in residential property, they will not be taxed. Digital asset, no, digital assets are not tax exempted in any way. There is a 30% tax imposed on cryptocurrency, digital asset. The profit that you make on them will be taxed. So which of these is exempted under these two sections? Only 1 and 3. It's a difficult question, but hey, if you can't solve a difficult question now at this time, where you are just 1.5 months away from prelims, then when will you? So that's a good practice for you. The answer here would be B. Do remember this. Okay, I hope you got this one. This is the example. If you want, you can take a screenshot as well. Alright, then let's move to the next one. Again, let's pause on this screen for a bit. Read the question carefully. Mark your answer in your sheet of paper, and then you can play again to see if you got this right or not. Alright. So the question is, which of the following actions can legally reduce or defer the liability of long-term capital gain tax under the current provisions of FY 24-25? First, investing long-term capital gain from sale of house property into NHAI, that is the National Highway Authority of India, or REC bonds under section 54 EC, yes. So if you made a gain and that money was used to buy a bond of NHAI, that is the National Highway Authority of India, you gave them the money to build infrastructure, the government will not tax. So basically the government is trying to push you towards giving money to them, because the government wants them to get funded. So if you don't want taxes to be imposed on you, you better give your money or invest your money in these bonds. That is the entire idea. Reinvesting the entire sale consideration for unlisted shares into residential house. We just discussed in the last question, this is correct, that will be exempted. So if you have unlisted shares of the company and you sell that money, if it goes into residential house or residential property buying, it will not be taxed. Offsetting long-term capital gain from equity against short-term capital losses. No. So see the offsetting example that I gave you, that if you make a loss in a transaction, you can offset or cancel that against a profit that you made. That is only applicable on long-term to long-term losses, short-term to short-term losses. You cannot cancel a short or offset a short-term loss with a long-term loss. That is not allowed. These are two separate instruments. They cannot be mixed up. So third is wrong. Carry forward long-term capital gain losses for offset against a future long-term capital gain tax for up to 8 assessment years. Yes, that is what I told you. If you made a loss in such kind of a transaction this year, you can try and see in the next 8 years, whenever you have a profit, you can cancel that or offset that. Up till next 8 years, it is allowed. So fourth is correct. So the answer will be 1, 2 and 4. A would be the correct answer here. Okay. A would be the correct answer here. I hope you got this one right. If you want, you can take a screenshot of this. Now I have a previous year question related somewhere to this. I hope you can solve that one. With reference to India's decision to levy an equalization tax of 6% on online advertisement services offered by non-resident entities, which of the following statements is or are correct? You can pause, think about the answer, play, and then I'll come back on the screen. What is equalization levy? Let me first tell you this very quickly. So, for a long time, India and many other nations, rather not just India, had this problem with online companies. Let's take an example of Google. Google or Facebook, how do they earn their money? Google earns its money mainly from the ads. So you pay money to the Google and they will show your ads on the different websites, on the Google search page, etc. Now what happens is, let's say an Indian company is giving money to Google to put ads on the websites. Because Google is not headquartered in India, the billing that Google does to that employee, the bill or the invoice that it will send, will be, let's say, from Ireland or from US. So what happens is, when the Indian government tells Google to pay the tax to us, Google says, oh, we are not an Indian entity. Google says that we are not in India, we are not an Indian entity, why should we pay a tax to you? So Google or these companies avoid paying taxes on the premise that we are not based in India, we are not catering or we are not headquartered in India. Most of our services or most of the bills that come in are from a foreign entity, so why should we pay the tax to you? The government of India, on the other hand, says that the money that you are charging, the money that you are taking is from the Indian citizens. So we deserve a part of that money in the form of taxes. These companies did not pay that tax because there was no law about it. So a few years back, the government of India, learning from other nations as well, started putting a tax called equalization levy, that at least this much tax you will have to pay. So equalization levy is mainly for those online digital companies that do not have a physical presence in India, and thus they misuse this clause by giving invoice or bill to the Indian citizens or Indian companies from their offshore companies and then denying a tax to the Indian government. For that, equalization levy was put. So that's the basic background of it. Now let's come back. First, it was introduced as a part of the Income Tax Act. No, it was introduced as a part of the Finance Act. So the first statement is wrong. Second, non-resident entities that offer advertisement services in India can claim a tax credit in their home country under DTA, Double Taxation Avoidance Agreement. No, this is not a part of that agreement. Now later on, maybe tomorrow or day after, we will discuss DTAA as well. Double Taxation Avoidance Agreement is a very unique system. Let's say there's a company, let's say Infosys. Infosys works in India, they work in UK as well, they work in US as well. Now Infosys, for example, because they have presence in multiple countries, can't keep paying taxes in every country. If they pay 25% tax here, 20% US, 20% UK, then they'll be left with no money. So what happens is, in order to avoid taxing the companies multiple times, major nations sign an agreement. Let's say India signed an agreement with, let's say, America, called the DTA, Double Taxation Avoidance Agreement, under which if a company has presence in India and US, both of the countries will not tax the company. There will be an agreement done, either there will be half and half, either we will decide where the company has more business. It depends on agreement to agreement, but that is called Double Taxation Avoidance Agreement. So the statement is saying that because Google pays this tax in India, they can tell America that now we will not pay tax to you because you've already paid equalization levy in India. Is this true? No. Double taxation avoidance agreement does not say that equalization tax can be offset or can be cancelled from other countries. That is what the statement is. Both of these are wrong. The answer thus will be D. This is the answer here. Okay. I hope you got this right. Moving on then to the next topic. The next topic that we have here is called secured overnight rupee rate, in short, SOR. Very interesting topic, very important topic also that you should know about, not just for the examination point of view, but generally as well for economics point of view. It's a very important topic to understand. Now, before we go into what exactly is this, there are a lot of technical words here. Let me explain to you the basic idea that we are discussing here. Banks earn profit by giving loans to people, right? How do banks get their money? When banks have to give loan, what money are they giving out? So banks get money in different ways. There are deposits that people make. Then banks can also take loan from RBI. However, there is one more option that the banks have. That is, banks can also take a loan from some other bank. So it is not necessary that a bank in India will only take a loan from RBI, that is Reserve Bank of India. A bank in India, let's say ICICI, can take a loan from SBI. It's a short-term loan. So this is a loan that is taken usually from other banks. Now, when let's say Axis Bank is taking a loan from SBI on a short-term basis, they have to pay an interest on that. No money is free. Banks also charge an interest on the other banks. So the rate of interest that a bank charges the other bank for short-term loan is called MIBOR. Mumbai Interbank Offer Rate. Because Mumbai is a financial capital, financial hub of India, it's Mumbai Interbank Offer Rate. So when a bank in India offers a loan to the other bank on a short-term basis, bank-to-bank transaction, that is called MIBOR. This is clear? Then, the next question that comes to our mind is, who decides the rate of MIBOR? Right now, it's a very unique kind of a system. MIBOR is actually decided on a basis of an average. So what happens here is, there are certain big banks in India that have been chosen by Reserve Bank. So Reserve Bank has made a list that, okay, you are the big banks, that you are the ones who run the economy. Let's make a list of it. The RBI will ask these banks that at what rate would you want to give a loan to the other bank. Let's say SBI says, I would be happy to give a loan at 8%. Then Axis Bank says, but I would be happy to give a loan at 11%. PNB says, I can give a loan at 7%. Then let's say HDFC says, I can give a loan at 9%. This is how the panel of the banks gives the rate of interest at which they are happy to lend. So the banks will give a rate of interest that this is where I am happy to lend. An average is calculated. So the rate of interest that the banks are ready to offer the loan, at which they are ready to offer the loan, there is an average that is calculated, and this average then becomes the MIBOR. This is how the current system is, okay? So I'll reiterate, if a bank has to take a loan from another bank, they do it on a bank-to-bank transaction basis. They do it on a rate of interest called the MIBOR. How is MIBOR decided? There is a list of banks in a panel decided by the RBI. They are the ones who will tell the RBI what is the rate of interest at which they will be happy to offer a loan, and in average of that is then put out, which becomes the MIBOR. Okay. Now the problem with this system is that this system of taking out the rate of interest or calculating the rate of interest is not foolproof. It's a random number. The banks might give a random number depending on the average of it. So the RBI also is not happy with it. So what they have done is they have tried to introduce another system which is called SORR, which is the topic. So they have introduced a new system called secured overnight rupee rate. Now again, please understand, this is not replacing MIBOR right now. It's not that the RBI says that we will replace MIBOR right now with this. The expectation is in the long run it will replace MIBOR. But it is not replacing MIBOR right now. It is just being floated by the RBI as one other method in which the banks will be able to decide the rate at which the other banks will be able to get them the loan. Now, there are certain differences between how MIBOR works and how SORR works. We will discuss those, but please understand, it is not replacing MIBOR right now. Now, this rate, that is a new method that RBI wants to introduce, SORR, it will be derived from actual overnight money market. It will be determined, the rate will be determined by secured overnight money market transactions. Now, heavy term, understand this. MIBOR was decided by what? Banks giving a random rate of interest and average was found out. But SORR will not go that way. To determine what SORR will be or the rate, you will have to look into the money market, at what rate is usually the loan given, and they will look at a secured money market. Secured money market means when you are taking a loan against a security. Let's say a bank, usually when they take a loan from the RBI, usually they have to give government security as a guarantee. And then against that guarantee, the loan is given to them. So the rate of interest here under SORR will be derived from the money market, overnight money market. And they will see in the money market at what rate is the money available for secured loans. It will also look into the repo rate and the tri-party repo. I hope that you know what repo rate is and tri-party repo is. In case you don't know, repo rate is the rate at which the RBI lends money to the banks. So when a bank has to take a loan from the RBI, the rate of interest that the RBI will charge them is called the repo rate. There's something called the tri-party repo as well. Tri-party repo, as the name suggests, is where three parties get involved, not the RBI. Let's say there's a bank A and there's bank B. Bank A wants to take money from bank B, but in order to do it in a correct manner, in order not to have any danger in between, they appoint some other third party in between. This third party will, what will it do? It will take government securities from bank A, keep it with them. They will take money from bank B, give them the money and give them the government security. They will act as facilitator. This is called as third tri-party repo, where three parties are involved, where a mediator party comes in to make sure that all the transactions are working fine. So all these will be taken into consideration before deciding what exactly will be SORR. That is the idea that in the long term, SORR will be a better representation of what is in the market, because when you calculate a rate of interest using these kind of methods which are right now available in the market, you will arrive at a much more accurate rate of interest rather than just having a random number from the banks and the banks taking out an average. That is not the correct way or the most suitable way of deciding a rate of interest, because that is not reflective of the market. This will be much more reflective of the market. That is why the RBI thinks that this will be a better way forward. Now, MIBOR, as I said, in simple terms, it is the price of borrowing. When a bank takes a loan from some other bank, the rate of interest that the bank will charge from them will be called as MIBOR. That is Mumbai Interbank Offered Rate. Again, the name of Mumbai because Mumbai is a financial hub. Similarly, you also have in the international market something called LIBOR. That is London Interbank Offered Rate. That's an international standard. So it's not a uncommon practice. Banks taking loan from other banks, it's a very common practice. It is not just seen in India. London has a similar kind of a thing called LIBOR, when money is lent on a short-term period. It can be for overnight, it can be up to a few months also, but usually for a short-term period when the money is lent, that is the rate of interest that is usually charged. Now, I told you how the MIBOR is calculated, and this is where I will introduce you to one more entity. Do remember this. There is an entity called Financial Benchmarks India Limited, FBIL. It is set up by RBI. They are the ones who officially calculate MIBOR. So MIBOR is officially calculated by FBIL. Remember this. And again, MIBOR is not going anywhere. Please don't think SORR is replacing MIBOR right now. In the long run, the expectation is that it will replace it. The actual rate is quoted by a group of major banks, I told you, which is called a panel, and MIBOR is the average interest rate that these banks agree on. So whatever the average is of the rate at which the banks are ready to offer the loan, that comes out to be MIBOR, and it is the FBIL that announces it. Please do remember, these are small minute details that are important for you. Now MIBOR is not the same as repo. Repo is the rate at which you take money or banks take money from the RBI. On the other hand, MIBOR is when there is an interbank transaction. Also, in MIBOR, that is when the banks are taking money from the other bank, this is unsecured, means there is no security of the government, there is no collateral, there is no guarantee being given. Means if the bank doesn't pay the loan back, there is no collateral or guarantee. On the other hand, when the banks take a loan from the RBI, they have to give government securities. That's why it is called repo. Repo means repurchase, where the bank gives its security to the RBI and tells the RBI, later on I will repurchase a security from you by giving the loan back. Now, one more thing here before I go ahead and complete this topic. See, the central banks around the world do this activity of trying to control the money supply. Now, please understand a very important difference between, let's say, the Reserve Bank of India and the Federal Reserve in America. Both are central banks of their respective countries. Both of them decide policy rates. Like if RBI has to control the money supply in the market, if they want to reduce the money supply, they would try to take money away from the bank. If they want to increase the money supply in the market, they will reduce the repo rate. They will tell the bank that the loan is freely available, take loan from us, distribute in the market. So they basically determine the money supply. Now, how do they do that? And how effective is it? Please understand. The banking system in India and the banking system in a country, let's say the US, is not the same. Like in India, people have deposited a lot of money in the banks. So when a bank in India, let's say HDFC, has to give a loan, they have enough money to give a loan because the people in India have deposited so much money in the banks. Because as an Indian, you don't have many options to keep your money safe or keep your money invested. So a lot of people in India, for example, still opt for bank and the banking system as a trustworthy way to safeguard their money or to grow their money. The result is, when RBI makes a certain change in policy, let's say when the RBI increases or decreases the repo rate, it does not have an immediate effect on the Indian market. Like when RBI says that repo rate is higher, means when the bank tomorrow goes to RBI to take a loan, it will be a very expensive loan. The banks do not really care, because banks say, I don't want money from the RBI, I have my own money, my customers have given me so much money, I don't really need any help from the RBI. So in India, what happens, because a lot of money from the people is already in the banks are not directly dependent on the RBI to take money from them and give out loan. The loans are given from the deposit that people have already made. On the other hand, a developed country like US, when you are a developed country, the result is that the people are more confident about alternate sources of investment. So in US, the people invest much more in the stock market. They invest much more, let's say, in property, cryptocurrency now. So they are much more aware financially of other sources or other ways in which they can earn money, they can invest money. So the result is, in the US, when the banks have to give out a loan, mostly it is the money that they take from Federal Reserve, that is, they first take money from Reserve Bank of India, their equivalent, and then they give out a loan from that money. So in US, when the Federal Reserve changes any kind of a policy, it will have an immediate impact on how the economy or how the monetary system is working. Because most of the money that is actually being given out as a loan is not the money in the form of deposit that the banks have. This is the money that they have taken from the central bank and then they are distributing it or they are circulating it. So in short, when the Federal Reserve in America changes their policy, it has an immediate impact on their economy. It has an immediate impact on the money supply. In India, when the RBI changes the repo rate, increases or decreases the repo rate, it does not have an immediate impact on the economy. It might have a long-term impact. But if they expect immediately just after a few weeks or few days something will happen, no, it will not happen. Because in India, we do not have this situation where the RBI controls a lot of money supply in the bank. So do remember that. Just give me a second, my pen dropped. Yeah. Now, SORR, that is the alternative that the RBI hopes in the long run will replace MIBOR, has certain advantages. As I said, this is not on the basis of a random average. This is much more data driven. This is something that cannot be manipulated, because we have seen in the past, in case of MIBOR, some banks have tried to manipulate it, because the banks know it's an average of the values that we give. So if 3-4 banks come together and intentionally say, oh, we will give a lesser value, so the price will reduce and it will be helpful for us. That is something that leads to manipulation. SORR will not let that happen. It is also in line with how the global market works. So globally also, that is how the interest rates between the banks are decided. Globally also, we don't have an average of these kind of rates. This is how SORR will be. Again, I'll repeat, it is not replacing MIBOR immediately. In the long run, the RBI expects that it will replace MIBOR, but it is not replacing MIBOR immediately. It will be more transparent. It will have much more participation, representation from the market. But at least for now, we are not going into that. This is the timeline for implementation. It has the responsibility to implement this in the long run, and to develop this is given to FBIL, again Financial Benchmark India Limited, that was established by RBI. Its rollout is expected eventually. It will replace MIBOR, again eventually, not right now. Similar kind of things happen in other countries, in US, UK, etc. MIBOR will be phased out eventually. It was introduced in 1998, but it has not led to a much efficient system. Again, it's subject to manipulation. The banks can manipulate it. They can form a cartel, and then they can decide if we want to increase or reduce the rate. That is why it's not the best way forward. Also, as I told you, just like we have MIBOR in India, we have LIBOR, that is the London Interbank Offer Rate. It is something that is followed in global markets, how the banks can actually take money from each other. This is short term. It is handled by UK. It has much more impact of the international currency. In India, MIBOR, etc., or SORR is not impacted by something that is happening outside India. Please understand. MIBOR or SORR will mainly be impacted by what is happening within the country, within our economy. They don't have an impact of something outside the economy. That is also a big difference. So it will mostly be inwards looking. Let's see if you can answer a few practice questions. Again, we'll do the same. I would urge you to pause on the screen, read the question carefully, and then mark whatever your answer is in your mind. Then you can play again, and then we'll discuss. Okay? All right. So, with reference to SORR, Secured Overnight Rupee Rate, consider the following statements. Number 1. SORR is a benchmark interest rate based on actual overnight repo transactions secured by the Indian government securities. As we discussed, this is correct. This is in fact one of the things that sets it apart from MIBOR. It is based on transaction of securities, so it is actually based on the rate at which the securities are being sold or securities are being kept. That is why it is a much better indication of what is happening in the market. Second, SORR is published by Reserve Bank? No, it is published by FBIL. We discussed this, not by Reserve Bank. And it is intended to replace MIBOR as a primary reference rate. Yes, it is intended, but this is the wrong part, not published by RBI. SORR has been endorsed by FBIL as a recommended fallback for contracts referencing MIFOR. That is correct. Now, this is not a mistyping. MIFOR is correct. This is not MIBOR. There is one more thing related to it called MIFOR. That is Mumbai Interbank Forward Offered Rate. F is for forward. Now what exactly is this? Forward offered rate, the simple idea is when the banks make a contract that I will lend money from you or I will borrow money from you after a few or after some time, but let's decide the rate of interest right now. That is called MIFOR. For example, let's say the State Bank of India says to HDFC that I will borrow money from you after 6 months at a rate of interest that we decide right now, so that later on when the situation changes, we will not be changing this. This is a contract. So when you think as a bank, when you think that later on the rate of interest might increase, let me fix a rate of interest right now that will safeguard me. That rate of interest will be called as MIFOR. So yes, SORR is recommended to be used now in place of MIFOR. MIFOR again is something that is offered by the banks as a rate of interest that they will charge for future loans to the other banks. So 1 and 3 here are correct. 2 of these given statements are correct. The answer thus is B. Because you have to tell how many of these are correct. B is the answer. I hope you got this one right. Okay. If you want the screenshot of this, feel free to do that. Moving on, one more question here for you. Which of the following characteristics, again, read this, pause on the screen, and then decide your answer, write it in the sheet that you have, so that you can check and then you can play it again. Okay. All right. Which of the following characteristics differentiates SORR from MIBOR or MIFOR? First, it is based solely on actual transactions and not on polled estimates. Yes, this is the biggest takeaway from this. This is the biggest shining mark for SORR. It is based on the real transactions in the market, the rate of interest at which the government securities are being kept for borrowing, etc. That is why this is much more secure. It is not subject to any average rate that is offered by the banks. So there is no average, etc. It is something that cannot be manipulated by the banks, even if they form a cartel. SORR reflects the cost of collateralized borrowing, whereas MIBOR reflects uncollateralized interbank borrowing. That is correct. Again, collateral means guarantee. Usually, when you go to a bank and you ask for a loan, if it's a small loan, they might not ask for a guarantee. But if it's a big loan, if you are taking loan of many crores or many lakhs, they might ask you to put a guarantee, property or something else, some asset that you own, and on the basis of that they decide whether they have to or they want to give you the loan or not. Similarly, when the banks take money from the RBI, they have to put government security as a collateral, government security or GSEC as you call it, as a guarantee. GSEC or a government security kind of secures the loan, it acts as a collateral, and the RBI can actually take that. If the bank does not give the money back, they can use that. So again, SORR is decided on the basis of collateralized borrowing, means on the basis of what interest rates are available in the market right now when you give something as a collateral, as a guarantee. MIBOR right now, or MIBOR, how that works is on the basis of uncollateral, or there is no collateral, no guarantee being given on those kind of loans. So second also is correct. Third, SORR is influenced primarily by global interest rate movements, especially US federal action, rather than domestic liquidity conditions. No, we just discussed SORR will not have any reference to what is happening in the global market. So it is not based on the global market or the global money supply or what is the Federal Reserve doing. It is mainly based on the basis of the domestic liquidity, what is happening in the domestic market, how the loans in the domestic market are being given for collateral or non-collateral purposes. So third will be wrong, 1 and 2 are correct. The answer thus is A. I hope you got this one right as well. Not a difficult question. Mostly on the basis of whatever we had discussed, you should have been able to answer this particular question. If you want, you can take a screenshot from here. Okay. Now, related to this, I have a previous year question also for you. Try and see if you can answer this particular question. It's a question asked in Prelims 2013. You can pause on this screen, read the question carefully, mark your answer in the sheet of paper that you would have, and once you're done that, you can play again. So the question here is, supply of money remaining the same, when there is an increase in demand for money, what will happen? So again, the supply of money is the same and there is an increase in the demand for money, what will happen? Now please understand this. The money supply remaining the same is the same kind of an example that we took for onions or tomatoes in the market. Supply of a commodity remains the same. The demand increases means it will be harder to get that. It's simple. If you have only 100 cars in India right now and there are so many people who want to buy a car, provided that all of them can afford a car, that would mean that the commodity or the car price will increase automatically, means it will be costlier. Similarly here, when the money supply is limited but there is an increase in demand, people want more money, what will happen? The cost of borrowing money will increase. If there are so many people who want money but the money supply is limited, it's constant, the result eventually will be that the cost of money, that the money that you require will increase automatically, right? So cost of money increasing means what happens? The rate of interest increases. That is the simple argument here. Because the money is not easily available now, there is limited supply of money and there are so many people who are asking for money right now, the result will be that it will increase the rate of interest. That is a simple answer. Now, one more clarification here very quickly. In the UPSC examination, in the economics questions, for example, you have a lot of times this being mentioned, that increase in interest rate or interest rate is decreased. A lot of times people get confused as in what interest rate are they talking about. You see there are two types of interest or rates of interest that you can see. One kind of rate of interest is when you go and ask for a loan from the bank. When you go to the bank and say I want a home loan or a car loan, and they will say I will put an interest on you. That is one rate of interest. Second rate of interest is when you deposit money in the bank. Let's say you deposit money in the savings account. They will give you an interest on that. That is one more rate of interest. So which interest rate are they referring to when the UPSC usually says increase in rate of interest? Are they referring to the interest that you are getting on the savings bank account? No. Whenever the UPSC in a statement says increase in rate of interest or decrease in rate of interest, what they actually mean to say is the rate of interest at which bank offers the loan. Please always remember this. They will not clarify this in the statement, but whenever the UPSC in the prelims exam has this kind of a statement that the interest rate will increase or interest rate will decrease on the bank, or the bank will do this in the interest rate, what they are meaning to say, what they refer to is not the interest that is paid on you on your savings or on your FD or RD. The interest that they are referring to is this. That is the rate at which the banks have to offer the loan. That is the rate of interest that they are talking about. So answer here is B. Pretty simple, straightforward. I hope you got this one right. This is the explanation. Money supply anyways is a recurring topic of the UPSC. They ask a lot of questions. Money supply, how does it increase, how would it decrease, and the effect it has on the long term. This brings us to the end of today's session. This was our session number 2, the prelims crash course that we have ongoing. This was our second economics masterclass. We have 12 more classes for you. Please do join us from Monday to Saturday, 12 p.m. to cover each and every economics related topic that has been in the news in the last 1 year or so. All these topics, as you have seen, will also have accompanying questions, for both the practice questions for you and related questions that have been asked in the prelims examination in the past. In return for all that effort that we are putting in for you, all that I ask is make sure that you do hit the like and the subscribe button so that you can be notified about any video, any new class that is happening here. Feel free to invite your friends here as well. Don't forget to join me tomorrow as we continue this, and we resume from here tomorrow at 12 p.m. where we will take up the remaining topics. Thank you so much for watching. Have a good day ahead. Do tell us in the comment section what your score was. My name is Harshmeet Singh, signing out. Bye-bye. Jai Hind.